Hi, I'm Nic Spicer, and welcome to this PortfolioMetrix quarterly update. The first quarter of 2019 saw a strong bounce back after a rather difficult fourth quarter of 2018. Equities moved strongly upwards as investors cheered a pause in tightening by the US central bank, as well as movement on the US and China trade talks. Global equities were up 10% over the quarter. Bonds also had a good quarter, albeit for slightly different reasons. Bond investors were slightly more worried about the macro outlook and also responded to compression in global yields. Global bonds were up 2.5% over the quarter. In addition, the pound strengthened over the quarter as a hard Brexit became less likely, although many uncertainties still remain. As mentioned, over the quarter, market performance was very strong. Global bonds were up 2.5%, and global equities were a lot more volatile, but also up strongly, with their MSCI emerging markets up 7.4% in sterling terms, the FTSE 100 up 9.5% in sterling terms, and global developed equities up 9.9% in sterling terms, including dividends. PortfolioMetrix performance was also strong over the quarter. Select 4, our mid-risk portfolio, was up 5.7% net of all investment fees, whilst Select 7, our highest risk portfolio, was up 8.3% net of all investment fees. Looking forward, certain risks have certainly decreased. The risk of excessive central bank tightening, the risk of a hard deal Brexit, and the risk of big ruptures between the US and China over trade. However, we are 10 years into this expansion, and it is the second longest expansion since the end of the Second World War. And the big difficulty is that whilst recessions are a terrible time to be invested, the late stage of a cycle is actually a very good time to be invested. So you don't want to pull out too early. So what does that mean for us? Well, it means that we're fine-tuning portfolios. We're trying to remain invested, but we aren't focusing more on value. We're focusing more on quality. We're trying to sort of reduce the aspect of excessive growthy exposure, as well as small cap exposure. But above all, we're trying to remain diversified to try and spread the risks that we're actually taking. Thanks for listening. And here's looking forward to a very good second quarter, as well as a good rest of the year.